Finance is a broad field that revolves around the management of money, investments, and assets. It plays an essential role in everyday life, business operations, and government policy, influencing economic growth and personal financial well-being. At the individual level, personal finance involves managing income, savings, investments, expenses, and planning for future financial goals such as retirement, home ownership, or education. A key element of personal finance is budgeting, understanding how much money comes in versus what goes out, and making decisions that allow individuals to live within their means, build savings, and invest for future growth. Additionally, personal finance also encompasses managing debt, using credit wisely, and understanding insurance to protect against unforeseen events. Corporate finance is concerned with how businesses acquire and manage capital to fund their operations and growth. Companies can raise funds through equity, selling shares, or debt, issuing bonds or taking loans, and must make decisions on how to invest this capital in ways that generate returns while managing risk. Corporate finance includes key concepts like financial planning, budgeting, capital structure, and the evaluation of investment opportunities. Financial managers are responsible for decisions that impact the profitability and risk profile of a company, such as whether to invest in new projects, buy back stock, or issue dividends. Public finance focuses on how governments manage their finances. This includes raising funds through taxes, bonds, and other means, and allocating those funds to meet public needs, whether it's infrastructure, healthcare, defense, or education. Governments also manage national debt, design fiscal policies, and regulate central banks that influence the money supply and interest rates. Effective public finance ensures that resources are used efficiently and that the economy remains stable, balancing the needs of the present with the capacity to pay for them in the future. A fundamental concept in finance is the time value of money, which states that money today is worth more than the same amount in the future due to its earning potential. For example, $1 today can be invested to earn interest or generate returns, whereas $1 received in the future does not have the same immediate utility. This principle is crucial for making decisions about investments, loans, and retirement planning, as it helps determine the present and future values of cash flows. Investing is one of the key areas in finance, where individuals and institutions allocate money into assets such as stocks, bonds, real estate, or even newer investment vehicles like cryptocurrencies. The goal is to grow wealth by earning a return on the initial investment. However, with higher returns typically come higher risks, and successful investors must understand how to balance risk and reward, diversify their portfolios, and make informed decisions based on their financial goals and market conditions. Risk management is an integral part of finance, helping individuals and businesses identify and minimize the potential for financial losses. This involves assessing different types of risks, such as market risk, credit risk, operational risk, and liquidity risk, and finding strategies to mitigate those risks. Companies and investors often use financial products like insurance, options, and futures to protect against unforeseen market movements or events that could impact their financial position. Financial markets play a vital role in the global economy. These markets, including stock markets, bond markets, and commodity markets, provide platforms for buying and selling financial assets, which allows capital to flow efficiently to those who need it, such as businesses and governments. Market prices are influenced by the forces of supply and demand, and investors use strategies like technical analysis, fundamental analysis, and economic forecasting to predict and react to market movements. Another key area of finance is financial reporting and analysis, which involves the collection, organization, and interpretation of financial data to help guide business decisions. Companies regularly release financial statements like balance sheets, income statements, and cash flow statements to provide transparency to investors, regulators, and stakeholders. Financial analysts use these statements to assess the financial health of a business, determine its value, and make recommendations for investment or improvement. Ultimately, finance is about making informed decisions under conditions of uncertainty. Whether managing a personal budget, running a business, or overseeing a national economy, financial knowledge and decision-making are key to achieving stability, growth, and success. The field combines aspects of economics, mathematics, and psychology to help individuals and organizations navigate financial challenges and opportunities in a constantly changing environment.